Now, Fernando had a, oops, sorry, Fernando, you had another question. You did have a last minute question. You said, after earnings, an IV crush, but at the same time, historical volatility increases. So I expect the sellers rise prices because of increase in the HV. How can you explain this phenomenon? Okay, well, Fernando, it all depends on what the stock does. At earnings, if you're a few days away from earnings, or you bought a position that's coming up to earnings, well, anyway, you hit earnings and the stock moves one direction or the other. Even if the stock has a drastic fall, most of the time you see an implied volatility crush. If a stock falls 8 or 9%, and it normally has just been holding around a 1, 2, or 3% range of movement, that 8% move is going to increase the stock volatility. But the event that caused the move is gone. So the implied volatility is going to just disappear. Okay? You were trading one way or another into a high implied volatility because the market was speculating a wide movement, knowing of this known event that was coming up. Fear, the risk. Sometimes that's how some gurus and some investors define implied volatility. It's the measure of fear or risk on a security because of a known event coming up. Well, after that event, the stock moves. Okay? The implied volatility, the risk of another 15, 20, 30% potential movement or swing one direction and the other is gone, so the IVs will dry up around the near-term expirations. But the stock moved. That's going to cause the historical volatility to move as well. It's not so much based on who's selling or who's buying. It's just the reaction of the market. All right, so here's what we're looking at here. We've got Freeport McMurray. They all started to increase, right? They're going up. Look at this, 0.51. So on October 4th, it was only at 0.47. As we got closer to the earnings on the 23rd, they're going up, 0.51, 0.48. Let's look at another tool real quick. Okay, and that other tool we're going to look at is the stock research tool. At this time, the 50-day volatility is at 0.39. This is on 10/21. That's kind of low. I understand that. It's at 0.39. Stock's trading at around 982, pretty high. All right. Now, let's go to October 23rd. 10/13. Applied volatilities are at 0.42. And date. I'm sorry, here. Let's go back here. 50-day volatility is at 0.38. 20 days close to it. Next day. Stock falls 54 cents or down 5%. Volatility didn't really move. The historical stock volatility didn't move up that much yet. But for the options, November series, stock drops 5% for earnings. These drop back down. Right? They were at around 0.5, 0.6. They dropped down to 0.44. The historical volatility stayed the same. If the stock had fallen further, these would still have collapsed. These November ones have collapsed because that event which caused it, although there's still panic, but the historical volatility would have increased. Current. No, I'm sorry. We don't want current, do we? After all that event, let's go back 5 days, November 12th. The December series is low. November series were all sort of in that 0.47 range again. But those we saw earlier that the December ones that are a couple weeks out, it dropped down to 0.3, 0.35. These are higher because they're getting closer to expiration. Deep in the money, deep out of the money. The stock's back up to 1104. And let's go to, so back at 0.4, let's go back to today. Let's just go to current. You see now the implied, I should have gone yesterday. I apologize. Go back to yesterday. See, they're all over the place because they're so close to expiration, but further out we're seeing 0.39s again. There's still some high ones in there. But going here to the stock now, volatility's up. The implied volatilities were sort of dropping a little bit, but the volatility 50-day is up because the stock's been jumping around. We saw it drop down to 9, then it came back up to 10, then it was back up to 11. And current day, volatility is up at 0.44, the highest it's been. Okay, the stock's moving back up. The volatility is increasing because why? The effect of the earnings, it dropped 5%. Started to rebound for it, dropped a little bit again. Started to move back up. We saw it go 10, now it's back to 11. So even though the stock's going up, you'd think the volatility would drop, but as far as the chart goes, the actual movement is increasing. It's bouncing all around. So the volatility of the actual movement of the stock is increasing, even though the implied volatilities are dropping because the event's gone. The event's over. Now, this is a longer time frame than you're talking about, but if there's a wide enough swing, a significant enough movement, 8, 7%, one direction or the other, you'll still see an IV collapse, and you'll still see the potential for the stock volatility to increase because it's changing. It's fluctuating in price. It's increasing its actual movement, which is increasing its volatility of the stock. But the IVs near term suffered the crush and are gone. It's just related to what the stock itself is doing, not necessarily pressure on the selling or buying, in my opinion. Okay, so that's the best example I can give. It's not a great example, I know. We sort of had to bounce around, but that's why you kind of see that. Because remember, this is what's happened in the past. You crossed an earnings, it caused the stock to drop 5%, and since that October 24th earnings, we've seen a couple days where the stock shot up to 10, went back down to 9, came back up. It's just bouncing around week by week, and now it's back up to 11. So just in the last 20 days, it's moved 3 points from its low, close to 3 points, 2.5 points from its low of about 860 or so. Well, that's a significant percentage movement in 20 days, isn't it? That's why the volatility is increasing. But the implied volatilities, although they're fluctuating, they've come down off that average of around 0.5 or 0.6 that we saw leading into 3, 4, 5 days away from the announced earnings on the 23rd because the event's gone. There's no, except for the unexpected, there's no reason to expect to see Freeport-McMoRan potentially drop 20, 30, 40% or jump 20 to 30% because there's no earnings coming out. That's not to say an event couldn't happen or they come out and give new guidance. They come out and say that the last report they made was erroneous or false. They've been lying about their earnings. I'm not saying Freeport is anything like that. We've just seen that in the past with certain companies we could name, haven't we? And so if they did, the stock still might fluctuate drastically. We wouldn't know that, but that would cause the implied volatility and the volatility to move as well. In this case, you got the volatility collapse and the stock volatility increase because there's more fluctuation now. Historical stock volatility is just looking over the last 50 days. So anytime you start to see those movements after an earnings, up, down, up, down, up, down, trying to find a base, trying to find a hold, your historical volatility might be increasing, but the near-term options IV have collapsed because the event's gone. Simple as that, I believe. And it's not that simple. So that's my opinion on that. All right. Well, ladies and gentlemen, thank you for your questions. I'm not going to run through the closing again because we already did that. We'll get these webinars archived for you. We posted 2 more archives today from last week, a discussion on Marriott puts and dividends that's available on YouTube, and also rolling down a naked put position. And we talked to, I can't remember if it was Jerry last week or who asked the question about rolling down naked puts. I apologize for that. But those are both posted on YouTube. You can check those out on the recent webinars. Just look for user power options, and you also probably all received an email today on that as well. Well, take care, everyone. Have a fantastic weekend. We'll see you soon. Good night.